Donald Trump has confirmed tariffs on the auto sector starting next week. Let's get more from Jamie Murray, president of Murray Wealth Group. Great to see you. Well, I guess one argument here is that maybe these are bargaining tactics and that he doesn't mean to stick with these big levies.
Definitely. I mean, every day there's a new message and a new tariff from the U.S. And so this is just a continuation of what we've seen over the last 2-3 months. It did seem like the tariff noise was quieting down the last couple of weeks with this April 2nd Liberation Day, as he calls it, coming up. And, you know, the focus had turned to reciprocal tariffs. So you tariff us, we're going to match your tariff. And now it looks like we're back to 25% across the board. Now, it is notable that USMCA parts are not impacted on April 2nd. Those are coming later after they have a chance to review it. And so maybe that is the negotiation window coming in.
Auto parts.
Auto parts, yes.
Right, yeah. But he doesn't seem, maybe we could pull up Ford and GM shares here. He doesn't seem worried about the damage to U.S. companies.
No, and certainly Ford and GM, from some analysis we've read, will be the most impacted from a profitability basis. Obviously, that's their home base. And, you know, they sell a lot of cars there. And even though the tariffs will disproportionately affect the European or Asian automakers that import vehicles into the U.S., you know, these they have much larger global operations, and they'll be a little bit more insulated on that front.
Are you tempted by Canadian stocks in general amid this concern over our economy?
Yeah, so I mean, even in the auto parts sector, we like Linamar. We've owned this for a long time, and certainly it's going through the toughest part of the cycle, we think. But this is a name that we think they make very valuable parts on the car, not commoditized, highly engineered components. And regardless of what the tariff outcome is, you know, we think Linamar is going to be able to retain a lot of their business. Now, they might see some. You might see the end market shrink, the auto sales in general come down, and that's going to be, I guess, at the bottoming of the cycle. But ultimately, I think we'll see them come out of the other side stronger. And certainly there's some other Canadian names that on the income side that we're seeing as great opportunities right now.
Right. You have some ideas here. Stocks with 7% yields or more, and CEOs that you say have been buying back shares in the open market.
Yeah, exactly. And so these are all companies that are in our MWG Income Growth Fund. We see very strong opportunity in these types of names. And so one example is Chemtrade. This is a stock with 7.5% or 7% dividend yield. They're a low-cost producer of a variety of specialty chemicals in Canada and the U.S. Whatever will be impacted by tariffs, they've said that they're able to pass those on to the ultimate consumer because they're still the low cost and provider of these chemicals. And so we think with interest rates in Canada coming back into that 2.5–3% range on shorter term yields, that's a great name to look at for income.
Okay, Chemtrade, and down from its highs, but still up about 15% in the past year. Your next idea, Doman Building Materials.
Yeah, so Doman Building Materials, this is they've actually, over the last few years through acquisition, built up a nice position in the treated lumber market, and they actually now control about 30% of the North American treated lumber market. And so they sell, they'll buy wood from the forestry companies, they'll treat it, they'll transform it, they'll put it through one of their mills, turn it into a higher value wood product, and then sell that to retailers like Lowe's across North America. And, you know, this is a company that the gross margins are fairly stable. They just pass through whether lumber prices are moving up or down. They're able to pass those prices on to the retailer, who ultimately passes them to the consumer. And with, I believe the yields are around 8% right now. And we think this is a great play for when consumer confidence recovers. You'll see the volumes pick up, and you get an 8% dividend while you wait.
And Doman, of course, has operations south of the border. They're big impression-treated lumber on both sides.
Exactly, Canada and the U.S., but most of their lumber, it's all bought locally, so they're not too affected by tariffs on that front.
And here's finally another company that has quite a bit of investment south of the border, Gibson Oil. They have a huge oil export terminal down on the Gulf of Mexico. Yeah,
so Gibson, they acquired this in 2023. It's a big crude loading terminal that they have long-term contracts with to export oil. As well, they have a very strong infrastructure oil storage business in Alberta. That was sort of their legacy asset. And we just see this as a very, again, stable company. They'll benefit, we think, from higher volumes that are going to come out of Canada in the next couple of years. And particularly if we do see a bit of a Canadian renaissance in the oil patch where we can get some more export capacity built, Gibson, there's going to be more need for storage where oil sands companies bring their oil in, park it for a day or two to then put it onto a new terminal or a new pipeline for export. So Gibson, very strong position. It's a 7.5% yield right now, and they've increased it about 5% every year, and we see that going forward.
Just finally, maybe we can put up a 5-year chart for the TSX Banks Index. What are you doing about those old reliables, Jamie? Are you overweight or underweight the Canadian banks?
Yeah, I think we're about market weight. Again, we're bottom-up stock pickers, and we like to focus in on which companies we see the best opportunities in. And in the banking sector right now, we've been acquiring TD Bank over the last 6 to 9 months. Obviously, everyone's aware of the challenges they had in the asset cap that was put on in the United States. So we were using that weakness to acquire a fairly large position in both our income fund and our global equity growth fund. And by all accounts, the new CEO who's in there seems to be doing a great job. They're accelerating this transformation they're looking to do. And the investor feedback to him has been really, really positive. So we're sticking with TD Bank.
Jamie, thanks very much.
Thank you.
Jamie Murray, president of Murray Wealth Group.